Hi, I'm Martin McGrath from Financial Edge Group. We specialise in helping people look after retirement. Today I want to talk about an annuity. What is an annuity? How does it work? And they're all a little bit different. So an annuity basically is providing and setting up a guaranteed income stream or a fixed income stream. There's different providers that provide annuities. They've been around for a long period of time. There's some tax planning elements of how they all fit together. But at a high level, it's providing a lump sum of cash to an annuity provider for a guaranteed return. It's a little bit like super, but it's in fact a lot different in the fact that they take the investment risk and you get a fixed guaranteed amount. So an example might be, we go and give them $200,000 and they guarantee to pay $2,000 a month every month for a fixed period of time. Doesn't matter if the share market goes up or down or what happens with interest rate, you know you're getting that amount every single month no matter what. Now there's some pros and cons that come with annuities. They're meant to make sure it factors into your overall planning. Typically annuities are fairly fixed, so if you want more per month, we can't really do that. If you want to take out 20 grand to upgrade the car, you can't do that either. So we need to make sure we're planning appropriately around that. So there's a few different types. One where you can do it for a fixed term. So we set up an annuity for 5 years or 10 years or 20 years. At the end of that, it's finished. Some of them, you don't get any money back because you get more per month, and at the end it's just finished. Some of you get some of your money back or the whole amount back, but you get less along the way. They're kind of fixed term annuities. The other major type of annuities that we use for clients in planning are what are called lifetime annuities, which is where they cover you for your life. So the longer you're alive, the more you receive those payments. There's some planning elements if you die early in that you get some refunds and stuff. Where they're important is it helps with longevity. Am I going to run out of money or not? The guarantee is there that you won't because they'll keep paying you for as long as you're alive. There's also some incentives there when it comes to Centrelink. That's not there with super and it's not there with the fixed term annuities. It's only here with these lifetime annuities. And that is that when you put money in there, let's say we put $100,000 in to make the maths easy. When we go back to Centrelink and say, oh, I've bought an annuity for $100,000, if it's a lifetime annuity, they only assess 60% of the value as an asset. So now that 100,000 annuity actually only affects your Centrelink by 60,000. And often for clients, they end up getting more pension because they've set up that annuity. And it gets even better than that. If after you've owned it for a while, typically 5 years, or you've reached 84, 85 years of age, the 60% drops to 30%. So that same 100 grand that's giving you amount every month is only going to affect your pension by 30,000, meaning you'll likely end up getting some more pension. There's a lot of planning elements that come to annuities. They're not suitable for everyone or every situation. Often we only put so much money into there because we need the flexibility otherwise. But clearly there's a good planning element of how and where annuities can be used, and that can be set up at any stage of life as well. Hopefully that's a good little overview of how annuities work. If you want to find out more or have a chat about that, feel free to reach out or jump on our Facebook page at Financial Edge Group. Talk soon.